everyone, and welcome to another deep dive. Today we're going to be cracking open Common Stocks and Uncommon Profits and Other Writings by Philip A. Fisher.
Ooh, a classic.
Yeah, Warren Buffett even credits Fisher's ideas as being like a major influence.
Yeah, it's pretty incredible.
First published all the way back in 1958.
Wow.
Still super relevant today. This book's all about long-term growth potential.
Yeah, and the thing about Fisher is he's not into chasing quick profits.
Right.
He's all about finding those hidden gem companies that have the potential to just grow steadily and outperform the market over years, even decades.
Like planting a seed.
Yeah.
And watching it grow.
Into a big oak tree.
But before we get into the nitty-gritty of how he picked stocks,
Okay.
I'm curious about the man himself. Who was Philip A. Fisher?
So he was definitely a unique character, brilliant, a little quirky, and deeply passionate about investing.
Okay.
And his son, Kenneth L. Fisher, who wrote the preface to the book, paints a really vivid picture of his dad. Apparently, he had this unusual habit of memorizing the names of all 435 members of the House of Representatives.
Wow, that's dedication. I can barely remember what I had for breakfast.
Right.
But it speaks to his meticulous nature.
Oh, yeah, for sure.
Like he was doing his homework. He wasn't just throwing darts at a stock board.
Oh, definitely. And he was kind of skeptical of those widely accepted investment strategies, too.
Robot.
He didn't just follow the crowd.
Interesting.
He forged his own path, and he focused on truly understanding the businesses that he invested in.
Okay, so let's talk about one of his most famous ideas, the scuttlebutt method.
Okay.
It sounds kind of like something out of a spy novel.
Yeah, a little bit. Well, it's kind of like being a detective, except instead of solving crimes, you're trying to uncover a company's true potential.
Okay.
Fisher believed in going beyond just the numbers, talking to everyone involved. Competitors, suppliers, customers, even former employees.
Wow.
He wanted the inside scoop, the stuff you wouldn't find in any financial statement.
So it's about connecting the dots.
Yeah.
Gathering all these different perspectives to kind of form a more complete picture.
Exactly.
But wouldn't that be incredibly time-consuming?
It definitely takes effort. But Fisher believed it was crucial to separate the hype from the reality. He wanted to see if a company's success was a fluke or if it was really the result of solid fundamentals.
Okay.
So he'd ask questions like, how do competitors view this company?
Interesting.
What do suppliers say about their management? Are customers genuinely satisfied?
It's like peeling back the layers of an onion, getting to the core of what makes a company tick. But how does someone even begin to gather all this scuttlebutt?
Well, it starts with curiosity. Imagine you're interested in investing in a company that makes electric cars.
Okay.
You could start by reading industry reports, attending conferences, even visiting dealerships and talking to salespeople, You could also reach out to suppliers of batteries or other key components.
No, tapping into different networks, becoming a bit of an industry insider.
Yeah.
And wouldn't talking to competitors be a little awkward?
Not necessarily.
Yeah.
Remember, you're not trying to steal trade secrets.
Yeah.
You're trying to understand the broader competitive landscape. You might ask questions like, what are the biggest challenges in this industry? Which companies do you admire and why?
Okay, I can see how that would provide some really valuable insights. But wouldn't some companies be hesitant to share information with a potential investor?
Well, it's all about building relationships and approaching the conversation with genuine curiosity. You're not there to pump them for information. You're there to learn and understand.
And wouldn't Fisher's scuttlebutt method be, especially valuable in today's world?
Oh, totally.
With social media and online reviews and all that?
Yeah, you can get the unfiltered opinions of customers and employees at your fingertips. But it's important to be discerning. You have to separate the genuine insights from all the noise and bias out there.
Like being a detective.
Yeah.
Sifting through the evidence to find the truth. So scuttlebutt is all about going beyond the surface. Digging deeper and forming your own conclusions.
Exactly. And this approach really sets the stage for Fisher's famous 15 points to look for when picking stocks.
Okay.
It's like a treasure map leading to uncommon profits.
All right, let's start digging into that treasure map. What's the first landmark on our journey to investment success?
Okay, so the first point focuses on a company's business characteristics.
Okay.
Fisher argued that you should look for companies with products or services with strong sales potential. not just today, but for years to come.
So not just what's hot right now,
Right.
but what has the potential to stay hot for the long haul,
Exactly.
spotting those future trends before they become mainstream.
Precisely. Fisher's challenging you to think like a detective.
Okay.
Looking for clues that a company's success isn't a fluke,
Fine.
but the start of a long-term trend. He wasn't interested in quick flips or market timing. He was in it for the long game.
And that long-term perspective really sets Fisher apart, doesn't it?
Mhm.
In a world obsessed with instant gratification, he was advocating for patience and careful observation.
Yeah, he was definitely ahead of his time. And, it's fascinating how this idea of long-term potential ties into his thoughts on when to sell a stock.
Okay.
He basically said, don't. Unless there's a fundamental change in the company's prospects he believed in, holding on for dear life.
Wow, talk about a contrarian approach. Most investors are constantly looking for the next big thing, jumping from one stock to another.
Yeah.
But Fisher was all about finding those rare companies that you could confidently hold for years, even decades.
Yeah, he was essentially saying, find a company you believe in, invest in it, and let the power of compounding work its magic.
And speaking of compounding, I'm curious about Fisher's perspective on dividends. Weren't those a big deal back then?
You'd think so, right? But Fisher had a rather unconventional view.
Okay.
He believed that retaining earnings for reinvestment and growth was often more beneficial for long-term investors.
Interesting. Why wouldn't investors want that regular income stream?
Right.
Wouldn't they prefer cash in hand?
Well, Fisher argued that reinvesting those profits back into the company could fuel even greater earnings growth,
Okay.
which would ultimately lead to a bigger increase in the stock price, much more than any dividends paid out. So he was essentially prioritizing long-term capital appreciation over immediate income.
So he's playing the long game, aiming for that exponential growth that comes from compounding.
Exactly. And he also discussed the tax implications of dividends, noting that they might not be the most efficient option for all investors.
So it's all about understanding the bigger picture, considering all the factors that can affect your investment returns.
Precisely. And that brings us to another fascinating aspect of Fisher's philosophy, the 5 don'ts for investors. He outlines these common mistakes that can really trip people up.
All right, I'm all ears. Spill the tea on these investment faux pas.
Okay, well, for starters, Fisher was very wary of promotional companies. You know, those companies that prioritize hype over substance?
Yeah.
He believed they often lead to unsustainable growth and disappointing returns. He was all about focusing on companies with solid fundamentals, not just flashy marketing campaigns.
So substance over style.
Exactly. And another don't is over-diversification. He argued that spreading yourself too thin can prevent you from truly understanding the businesses you invest in.
Makes sense.
So he believed in focusing on a select group of companies that you really believe in.
So it's quality over quantity.
Precisely. And this ties back into his scuttlebutt method. Fisher was a firm believer in doing your own research and developing your own conviction.
Okay.
He warned against blindly following the crowd or relying on hearsay. He emphasized the importance of independent thinking in the investment process.
Like he's saying, don't just take someone else's word for it. Go out there and do your own digging.
Exactly. He wanted investors to be empowered to make informed decisions based on their own research and understanding.
All right, that's a wrap on part 1 of our deep dive into common stocks and uncommon profits. We've just scratched the surface of Fisher's wisdom, and there's so much more to explore.
Yeah, in the next part, we'll delve deeper into those 15 points, unpacking each one and providing practical tips you can apply to your own investment journey.
So be sure to stick around.
Yeah.
Welcome back, investors in training. We're continuing our deep dive into Philip Fisher's common stocks and uncommon profits.
Back for more wisdom.
Last time, we uncovered the man behind the method
Yeah.
and how his scuttlebutt approach was like channeling your inner Sherlock Holmes
Like that.
to investigate companies.
Yeah, it's about getting the real story, not
Yeah.
just like the polished version you find in those annual reports.
Exactly. And now it's time to crack open that treasure map of his 15 points for picking winning stocks. We left off with the first point, looking for companies with long-term sales potential.
Right.
What's the next landmark on our journey?
Okay, so point number 2 builds on that idea of future potential.
Okay.
Fisher stresses the importance of determining the growth potential of a company's products or processes.
Okay.
He's saying you got to look for companies that are constantly innovating, not just resting on their laurels.
So it's not enough to have a great product today.
Right.
You need to be thinking about what you'll be selling tomorrow
Totally.
and the day after that.
And the day after that. And it's not just about coming up with flashy new gadgets.
Yep.
Fisher emphasizes efficient research and development. Companies should be investing wisely in innovation, making sure those investments are actually paying off.
It's about being smart with your resources, not just throwing money at every shiny new idea. Kind of like how we're being smart with our time right now
Exactly.
by listening to this podcast.
Yes?
Instead of like endlessly scrolling through stock tickers.
You got it. You got to prioritize. And that leads us to point number 3, which is all about having an outstanding research and development team.
So we're talking about the brains behind the operation, the
Mm.
people who are actually making those innovations happen.
Exactly. Fisher believed that strong leadership in research, a well-defined structure,
Okay.
and a culture that fosters creativity and collaboration were all essential for success. It's like assembling a dream team of innovators.
Ooh, it reminds me of like those heist movies where they bring in specialists for each part of the plan.
Yeah.
You got your hacker,
Yeah,
your
that-
explosives expert, your getaway driver.
Forger.
Each person plays like a crucial role.
I love that analogy. And just like in those movies, teamwork is key. Fisher really gets into the nuances of how research teams should operate, like
Yeah.
the importance of having a diverse range of skills, effective communication, and a shared vision.
It's not just about having a bunch of brilliant minds in one room.
Right.
It's about making sure those minds are working together harmoniously towards a common goal.
Absolutely. Now, point number 4 might seem obvious at first,
Okay.
but it's often overlooked. It's about evaluating the effectiveness of a company's sales organization.
Okay, it's like that saying, you can have the best product in the world, but if you can't sell it,
Right.
it's worthless.
Exactly. Fisher believed that even the most groundbreaking innovation won't succeed if the company can't get it into the hands of customers.
Right.
He stresses the importance of a solid sales strategy, skilled salespeople, and a deep understanding of the target market.
So knowing your audience, understanding what they need, what motivates them, and how to reach them effectively.
Right. And Fisher also emphasized the importance of after-sales service.
Oh, okay.
He recognized that building long-term relationships with customers was crucial. It's not just about making the initial sale, it's about cultivating loyalty
Wow.
and creating a positive customer experience.
Exceeding expectations, going the extra mile to make sure customers feel valued and appreciated.
Yes.
Because like a happy customer
Yeah.
is more likely to come back for more and tell their friends.
Absolutely. Word-of-mouth marketing is incredibly powerful.
Yes.
And that brings us to point number 5, which focuses on profit margins.
Okay, so now we're getting into the financial nitty-gritty.
Yeah,
This is where we see if a company's actually making money.
exactly. Fisher argued that while sales growth is important, it's equally crucial to examine how much profit the company is generating from those sales.
Okay.
He believed that companies that can consistently improve their profit margins are more likely to be exceptional long-term investments.
So it's not just about selling a lot of stuff.
Right.
It's about selling it at a price that generates a healthy profit.
Yeah,
Finding that sweet spot between pricing and volume.
precisely. And there are several factors that can contribute to improving margins, like streamlining operations, reducing waste, negotiating better deals with suppliers, and even raising prices strategically.
Efficiency smart management.
Yeah.
Squeezing every bit of value out of the business.
Exactly. Now, point number 6 might sound a bit technical,
Okay.
but bear with me. It's about cost analysis and accounting controls.
Okay. So we're going beyond those flashy product launches and diving into the less glamorous world of spreadsheets and financial statements.
Exactly. Fisher believed that understanding a company's cost structure
Oh, wait.
and ensuring they had robust accounting practices in place was essential for long-term success. He argued that companies with strong cost controls are better equipped to weather economic storms and maintain profitability in challenging times.
So having a solid foundation.
Yeah,
Making sure the financial underpinnings of the business are strong.
absolutely. And it's interesting how this point connects to our earlier discussion about scuttlebutt.
Oh, I see it. By talking to employees, suppliers, and even competitors, you might get a sense of how efficiently a company operates. You might hear about waste, mismanagement, or areas where costs could be cut.
Exactly. It's all about piecing together that mosaic of information to get a more complete picture of the company's financial health.
So we're not just looking at the numbers on a spreadsheet. We're using our detective skills to see if those numbers tell the whole story.
Precisely. Now, point number 7 gets a little more subjective. It's about assessing those aspects of the business that are relatively outstanding and important in relation to its competition.
Okay, so This is where we try to uncover those hidden strengths and weaknesses
Yeah,
that might not be obvious from just looking at the financials.
exactly. Fisher believed that by talking to competitors, suppliers, customers, and industry experts, you could gain valuable insights into a company's competitive advantages and potential challenges.
It's like getting the inside scoop, the intel that only those immersed in the industry would know.
Exactly. And that's just 7 of Fisher's 15 points. We've still got a lot of ground to cover, so stay tuned for more invaluable insights from this investing legend.
Welcome back, fellow wealth builders. We're wrapping up our deep dive into Philip Fisher's common stocks and uncommon profits.
It's been quite the journey.
We've been decoding his 15-point treasure map for picking winning stocks.
Yeah.
Honestly, my notebook is overflowing with insights.
I know, right?
It's amazing how relevant these principles still are.
Totally.
Even though this book was first published way back when black and white TVs were like all the rage,
Rigorously.
we've covered a lot of ground from like analyzing sales effectiveness and profit margins to the importance of efficient research and development.
So much good stuff.
Now let's tackle those final points and see what other gems we can unearth.
Okay.
What do you think?
All right, so point number 8 focuses on something we haven't talked much about yet. Outstanding labor and personnel relations.
So treating employees well,
Yeah.
making sure they feel valued and respected.
Exactly. Fisher believed that companies with happy employees tend to have higher morale, lower turnover, and greater productivity.
Okay.
He emphasized fair wages, opportunities for advancement, and a culture of respect and appreciation.
It's like that old saying, happy employees make happy customers. It makes sense. If people feel good about where they work, they're more likely to like go the extra mile.
Absolutely. And, in today's world where attracting and retaining top talent is more competitive than ever, this point is even more crucial. People want to work for companies that align with their values and treat them well.
It's not just about the paycheck anymore. It's about purpose culture and a sense of belonging.
Right. And that leads us to point number 9, which is all about executive relations.
Okay.
Fisher believed that strong relationships and open communication among top management were essential for effective decision-making
Okay.
and a smoothly running operation.
So if you're talking about teamwork at the executive level,
Yeah.
having a leadership team that's on the same page and like rowing in the same direction.
Exactly.
Okay.
Fisher cautioned against companies with excessive internal politics or power struggles,
Right.
because those things can be incredibly distracting and damaging to the company's overall performance.
It's like a sports team with players fighting amongst themselves. They might have individual talent, but they'll never win a championship if they can't work together.
That's a great analogy. And point number 10 builds on this idea of strong leadership. It's about management depth.
Okay.
Fisher believed that companies with a deep bench of talented managers were better positioned for long-term success.
So it's not just about having a superstar CEO at the top.
Right.
You need a strong team of leaders throughout the organization.
Think of it like a basketball team. You need more than just a star point guard. You need a solid bench of players who can step up and contribute when needed.
So having a pipeline of future leaders ready to take the reins when the time comes.
Exactly. Fisher emphasized the importance of identifying and developing promising talent within the organization. This ensures that the company can continue to thrive even as leadership changes over time.
It's about building a sustainable future, not just focusing on short-term gains. And I think that's a recurring theme throughout Fisher's philosophy. He's all about the long game.
Absolutely. Now, point number 11 might seem like a repeat from earlier,
Okay.
but it's worth revisiting. It's about cost analysis and accounting controls. Fisher believed that companies should be able to maintain or improve their profit margins even as sales volume grows.
So it's not just about getting bigger.
Right.
It's about becoming more efficient and profitable as you grow.
Right. It's easy to get caught up in the excitement of rapid growth, but it's important to make sure that growth is sustainable and profitable.
It's like making sure your foundation is strong enough to support a taller building. You don't want the whole thing to come crashing down.
Exactly. And that brings us to point number 12, which ventures into a more specialized area. It's about those other aspects of the business that are relatively outstanding and important in relation to its competition.
Okay, so this is where we put on our detective hats again and try to uncover those unique advantages that set a company apart from the pack.
Precisely. It could be anything from a superior distribution network to a highly skilled workforce to an exceptional brand reputation. It's about identifying those intangible assets that give a company a competitive edge.
It's like that secret ingredient that makes a dish truly special. You might not be able to pinpoint exactly what it is, but you know it when you taste it.
Ah, I love that analogy. And sometimes these advantages can be hard to quantify,
Yeah.
but they can make a huge difference in the long run.
It's about looking beyond the obvious right, seeing the bigger picture,
Mm-hmm.
understanding the subtle nuances that can contribute to a company's success.
Exactly. Point number 13 deals with long-range outlook.
Okay.
Fisher believed that companies should be willing to sacrifice immediate profits to build long-term value.
So playing the long game again,
Yeah.
resisting the temptation to chase short-term gains,
Mm-hmm.
and focusing on building a sustainable business.
Precisely. Fisher was a strong advocate for companies that invest in research and development,
Right.
cultivate their workforce, and build strong customer relationships, even if those efforts take time to pay off. He believed that companies that prioritize short-term profits at the expense of long-term growth are ultimately harming their shareholders.
It's like planting a tree. You don't expect to harvest fruit the next day.
Yeah.
You nurture it,
Yeah,
give it time to grow, and eventually you'll reap the rewards.
beautifully put. And finally, we come to point number 15, which might be the most important of all. Management integrity.
So honesty, transparency, and ethical leadership.
Exactly. Fisher believed that a company's management team should act in the best interests of its shareholders, not just themselves.
Okay.
He emphasized the importance of a strong ethical compass and a commitment to doing the right thing, even when it's difficult.
It's about building trust, right?
Yeah.
Creating a company that people believe in and feel good about supporting.
Absolutely. And, in today's world where corporate scandals and ethical lapses seem to be all too common,
Yeah.
this point is more relevant than ever. Investors are looking for companies they can trust, companies that operate with integrity and transparency.
It's not just about maximizing profits at any cost.
Right.
It's about building a sustainable business that's good for shareholders,
Mm-hmm.
employees, customers,
Yeah.
and the world at large.
Well said. And that, my friend, is the essence of Philip Fisher's investing philosophy.
Wow.
It's about more than just crunching numbers.
Mhm.
It's about understanding the nuances of a business,
Right.
the people behind it,
Yeah.
and its potential to create lasting value.
It's been an incredible journey exploring these insights with you.
I know, me too.
I feel like we've uncovered a treasure trove of wisdom that we can apply to our own investment decisions.
Yeah. So what are your key takeaways from this deep dive? What resonated most with you? Share your thoughts in the comments below.
And be sure to subscribe to our channel for more insightful deep dives into the world of investing. Next time, we'll be exploring a book that presents a very different perspective on the market, A Random Walk Down Wall Street by Burton Malkiel. We'll be diving into the fascinating world of efficient market theory and indexing, so don't miss it.
Until then, happy investing.